Hey everyone, and thanks for jumping back into the cryptoverse. Today we're going to talk about Bitcoin and the time derivative of moving average division. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, also check out the Telegram channel, which you can find a link to in the description below. Yesterday we discussed moving average division, and by yesterday I mean a few hours ago. One of the interesting things, though, about these moving averages, or let's first discuss the indicator in terms of a lagging sense. Unfortunately, looking at the division of moving averages, like say the 100-week divided by the 200-week, they don't really give you a good indication of tops or bottoms. Okay, they simply do not. If you draw a line from here, October 2016, where the bottom was, and go up, you can see that the bottom was in a long time before. In fact, the bottom came in January 2015. The moving average division didn't bottom out until October of 2016. So it's important to remember that these are lagging indicators. But historically, when it bottoms, the trend tends to be up for a while after that. And then when it hits a top, like here, the trend went down for a while. Okay, and we were more or less just in an accumulation phase as new people came into the market, people who were holding bags slowly left the market. However, if you think back to calculus, what do we know about time derivatives? What do we know about if we were to take the time derivative of this? Well, one thing we notice is there's an inflection point. Okay, there is an inflection point on this curve, around this point. And what that means is it goes from being concave up to being concave down. Okay, so this would be like concave up, and then this is concave down. So this inflection point, does it have any value? Well, let's take a look. So first of all, let's scroll this up, and then we're going to take the time derivative of this curve to simply try to find where it changes direction. Okay, so that's what we ultimately want to know. We want to know where the slope is starting to take on a new path. So let's go look at that. If we scroll this up, you can see that in fact we see a momentum shift in the time derivative of the 100-week divided by the 200-week right here. The week of December 11th, 2017. This is right through the peak. Okay. Now, obviously, it's easy in hindsight. It's simply easy in hindsight. It's too easy in hindsight. At the time, you would not necessarily know that was the top, right? There's no way you could know at the time that was the top. It could have been that this was the top, and then it started going back down, and we would have come back to this and said, oh, well, it makes sense because it was concave. It came like this, and then eventually it turned over and did something like that. So hindsight has a way of making things seem easier than they might otherwise actually be. But that doesn't mean we can't use this going forward. For instance, in the same manner that this is decreasing over time, the amplitude is decreasing, maybe we would expect this to also decrease over time. And perhaps the eventual, the time derivative where we get that inflection point, maybe it'll come around the same level, or maybe slightly diminished in the same way that this is slightly diminished. You can see we've sort of had an inflection point, or not an inflection point, but a key, like a shift in the momentum there, but we're not really seeing too much of an indication so far on the chart. Obviously, we've just started moving up. It could be that this is the first little bunny hill on the way to something much more substantial. Okay? So I think this will be another useful tool. I mean, imagine a scenario where this is doing something like this, where it's coming up and it's putting in a new top or something, but we want to know where the inflection point is, okay? And I don't know exactly how high this will come up or how quickly. It could come up like this, and we would get an inflection point sooner. Maybe it does something like this, and then it ultimately doesn't hit the top until much later, like we've seen it already somewhat do for the 50-week divided by the 200-week. So we simply do not know. I think what's more important is how we ultimately react to it. So if we see something where we get this slow buildup for a while that ultimately comes up and does something like this at some point in the future, we don't know if it'll happen, say, within a year. It might happen longer than that. But this could be one more tool we can put in our toolbox to help us identify the market cycle top. Again, all models are wrong. Some are useful. This model is not going to be perfect in identifying anything, but it's just one more thing we can look at. The other thing we can look at is, well, is it useful in identifying bottoms? Right? Is that useful? Well, the time derivative hit a bottom here, and then it hit another one here. So it hit a bottom all the way down at this point. It came back up, hit a higher low, but this was ultimately around the time of the bottom. So the time of the bottom was here, and this bottomed a few weeks before it. So I would say that this does not definitively tell you where the bottom is, but when you see the moving average, the time derivative of the 100-week divided by the 200-week, when you see it getting to these levels, it historically gives you a few week window. You can see this one showed the bottom around November 26 or so, which is pretty close to when the bottom actually occurred. So if in the distant future we see something where this continues on up, something like this, and then ultimately, or it could happen sooner, of course, but then ultimately it dumps back down, when it gets into this area, a lot of people would be significantly scared, right? They're going to be scared. And this point would maybe help us get an idea of the global bottom, or the local bottom for that cycle within a few weeks, plus or minus a few weeks, right? What's a few weeks among friends? So this is just one more thing we can hope to use to help us navigate the market cycles. It's simply the time derivative of the 100-week moving average divided by the 200-week moving average on the weekly time frame. If you guys like the content, make sure you subscribe. We do things a little bit differently here. We look at a lot of custom type analysis. We explore possibilities. Some pan out, some don't. Make sure you subscribe. Give the video a thumbs up. Also, check out the Telegram channel in the description below. We also have the premium list at intothecryptoverse.com. That'll wrap it up for the video. I hope you guys enjoyed it. I will see you next time. Bye.